Welcome back to The Compass. My name is Derek McPherson. I'm the Executive Chairman of Olive Resource Capital. And with me, as always, is Sam Pelez, President, CEO, and CIO of Olive. It's been just over a week since we probably recorded an episode, so lots of news and lots of news happened in the markets. We'll get into all of that, but maybe just a bit of a throwback to our most recent episode, which was we were talking about kind of talking about how the macro is changing and how obviously at that point gold had pulled off a whopping $300, which seems felt like the sky was falling at the moment, especially when you looked up at your screen. And things seem to have, sort of found a level, kind of around, gold seems to have found a level around 4,000, just below. Silver's in I would say a similar location, kind of, just below 50, 47, 48, 49. Again, sky's not falling. Most of the gold and silver universe makes money at those prices, makes a lot of money at those prices. We'll get into that. We'll talk about a couple quarters here, but between since we last kind of recorded an episode, the Fed met, and obviously the Fed's always critical for the macro. And so, Sam, we were talking a little bit before this about global liquidity, and you had some thoughts on that.
Yeah, so most recently we've been talking about how this is typically a weak seasonal period. We didn't see really much weakness in September when it typically starts. October was a weak month. Now into November, as we're recording this on the first Tuesday in November. Our view is that November is a month to deploy, but it's a month where we may see continued weakness. And what's changed since our last episode is, as you mentioned, the Fed meeting and the Fed announcement. They did cut rates as expected, but I think the kind of like the tangent or derivative of that is that we're seeing a little bit of a slowdown in global liquidity. We've been talking about global liquidity being at all-time highs and increasing over the past few days since the U.S. Fed announcement. We've seen liquidity sort of tail off a little bit with the associated kind of weakness across most markets. Gold's obviously off the highs. For the higher beta people, Bitcoin is also off the highs, and even the U.S. market, which just was at all-time highs last week, it also appears to be off the highs. And I think it's important to know that direct correlation between global liquidity and effectively appetite for risk assets. What does this mean for us? Well, the next Fed meeting is not till the first week of December. So whereas perhaps we were thinking that we're still missing the flush where the weakness kind of forces people off their positions, and that becomes a great opportunity to start buying again and rebuilding positions. We were thinking that could happen as soon as the first or second week of November. I think now with this new reality, we think that maybe we'll see a little bit more weakness here in the month of November, and perhaps it's not till as we get closer to the Fed meeting that first week in December when things start to correct and we may start rebuilding the positions. Having said that, fundamentally over the medium to long term, nothing's changed. We remain of the view that the monetary debasement theme is as strong as it's ever been. And, and as we're going to get into here, because the real subject of this episode is the Q3 reporting more than the macro update. The companies are doing phenomenally well in this market context in spite of the volatility.
Yeah, I mean, I think that's a very valid point. I think not all the stocks ran all the way to that sort of $4,300 implied gold price, and I think so we didn't see as heavy a pullback. And if it was sort of short lived. There were probably some pretty strategic opportunities to get in if you were timed the market perfectly, which my experience is virtually impossible to do. But certainly as some of these stocks have pulled back off the highs and then now are sort of finding a base and rebuilding, and kind of what we one of our thesis or catalyst that we thought might come out of that pullback in gold was the fact that Q3 reporting was starting. And the fact that all these companies were going to show these really good cash flow. Now we're kind of right in the middle of Q3 reporting season. I guess the two biggest companies, or I don't know if they're the biggest gold producers, but probably the two biggest by market cap, have already reported. So I think that's a critical element, critical something we're going to discuss here, both with Agnico and Newmont. And I think that that's part of, people look around and go, okay, yeah, hey, you look at Agnico's quarter, they're still, at $3,400 gold, they generated, $13 million in free cash flow a day, and then, add $500 to that, it's another $4 to $5 million. So, between when we recorded the last episode of today, which is about a week, it's about 10 days, Agnico's done $150 million in free cash flow. So they paid for their Perpetua investment in that time period. So,
no, yeah, like the numbers are staggering, and I think part of the reason we want to do this episode and do this Q3 reporting is to, when you're watching the news every day and you're watching the price of gold move up and down and the news headlines, sometimes it's easy to lose sight of the real fundamentals. And the fundamentals here are that some of these companies have never been in better shape, and the profitability numbers that we're seeing and the derivatives of that in the sense of new investments, which there's a few we'll talk about in the second year as well, but also the buybacks that we talked about 2 episodes ago that may get, the companies can restart them as soon as they report their earnings based on the fact that they don't have any proprietary information that the market is not aware of. That obviously clears out when they report the Q3 numbers. So, we think there's a great time in the market.
Absolutely. Just to give everyone a quick, rundown or our take on we'll start with Agnico's earnings. $3 billion in revenue, $2 billion in EBITDA. That's phenomenal margins, right? If you think about that from 66% gross margins, or margin, I guess, EBITDA margin. All-in sustaining costs, sub $1,400 an ounce. Again, spectacular. What you'd expect from Agnico. Let's be brutally clear. And again, they did where's the free cash flow number? $1.2 billion in free cash flow. $1.2 billion in free cash flow. Not, and so yeah, like when they have opportunities, and I guess this is going to lead into some of our other conversations later for things that are a little more critical for our portfolio. But you look at they're 100. I was having this discussion with another kind of investor in the space, and it's like their $180 million investment in Perpetua. Where Perpetua is the Midas project is 300,000 ounces a year, has a massive antimony kicker. It's a project and it's permitted in the U.S. It's in Idaho. Those are rare assets. And so for them to put $180 million into it, is a sign of confidence. But also, kind of joked at the beginning of start talking about the quarters. That's at $4,000 gold, they're generating $17 to $18 million a day in free cash flow. It's literally 10 days of operations of free cash flow for them. So not insignificant, but not really something that, it's not, it's certainly not, they're not stretching the corporation in any way, or the balance sheet of the corporation in any way, shape, or form to do that, to make that equity investment. And actually, once we get through the quarters, we'll talk about a couple other equity investments that I think are exactly what we've strategic equity investments that are exactly down the middle of the plate of what you'd expect.
Yeah, no. So I think we're going to start seeing a lot more conversation about the balance sheets, not in the sense of leverage, but what do we do with all these assets in the form of current assets, cash, etc. Where does that money go? In our view, as we've discussed on this show multiple times, we think there is still the delta to the developers. It's extremely large, and it is my view that a lot of that cash is going to find its way into the developers, either by straight equity placements like we're seeing, or just outright cash takeouts, which haven't been as common in our space. But I think with these levels of profitability, that's what you would expect as a shareholder or producer, is not to risk the shares, but just literally use the cash.
Well, we saw that we saw that late last week with Fresnillo and Pro, and I think and actually when we're going to talk about M&A in a second, but as well, but that valuation arbitrage, right? The developers aren't, I mean, and obviously they shouldn't be. Developers aren't valued like producers, right? That ounce of the ground and a developer and ounce of the ground with a producer are two different things, and or that NAV multiple or whatever. And however you want to look at it, there's always a delta, and so you know, as a developer, you could take that project, or as a producer, you could take that project that's worth trading at 0.4 times NAV and make it instantly worth 1 times NAV by paying a 20% premium. So you get a massive amount of accretion. You can get a massive amount of accretion on that. Now, the key is generally to be early in the cycle. Just before we get away, we get into M&A or we get into strategic placements, which are kind of the function of this, of the reporting. Let's briefly talk about Newmont. $8 billion in revenue, or 7.96. You know, adjusted EBITDA of 3.3 billion, so pretty significant. Not as good margins as Agnico because they're not Agnico, but you know, that free cash flow, 1.6 billion free cash flow in the quarter, on 1.4 million ounces of attributable production. Pretty good, pretty good. Again, you know, so that's $17 million in free cash flow a day for Newmont. Newmont's got more debt and doesn't generate quite the same margins, but still $17 million in free cash flow a day. But if you tack on the gold price change, so that's, remember that the average gold price for Q3 is like 3,500, depending on the company. If you look at, you know, where the gold price is today at 4,000, so fun math, you could add $500 to the gold price. That $500 could be like $7 million a day in free cash flow for a company like Newmont. So go from generating 17 to 25. It's not a straight. You can't just multiply the ounces by the dollars, because there's royalties and a few other things in there that all actually, royalties become more valuable. That's why the royalty companies are doing so well. But you know, these are big numbers of cash flow, and it's not a surprise that these companies are out making strategic investments, buying things, etc. So where do you want to start? M&A first? Do you want to go to strategic investments first?
I think we should do M&A first, because also I think there's a chronological sequence in which things happened over the last the last week and a half.
All right, so M&A, actually a very interesting theme in the M&A. Silver companies buying gold, which is interesting. And I guess let's start. So last Friday we saw and and one of the first developers got bought as well, which I think is actually very interesting from a market point of view, right? We've seen a lot of producer mergers or things like that, but this was one of the first developers got. And then we're talking about Fresnillo acquiring Probe.
I want to start with the obvious fact, which is the complete shock that the news headline provoked in the fact that the largest silver producer in the world, with assets concentrated almost, I think, exclusively or almost exclusively in Mexico, is buying a gold project, not in New Mexico or Arizona, but in Canada. That was, you know, sticker shock for me when I saw the headline. And the only thing I can think of is sign of the times. We've talked about this many times. The lack of investable silver opportunities, it's real. Like the silver companies really can't grow at the rate that this kind of market demands, and they're finding opportunities in gold in particular, because the silver producers tend to trade at a much higher multiple than the gold producers. So pretty much any transaction of this nature is immediately accretive to the bottom line. In this case, it's a development asset, so it's not going to be immediate, but the accretion is so evident and tangible that I think it's very easy for a board of directors of the buyer, of a silver producer, to sign off on a deal like this.
I just want to go back to that point about Fresnillo coming out of Mexico, right? I think let's set aside the fact that they've really had one jurisdiction for their entire existence. And then even on top of that, I'm going to say this as someone of Latin American descent, and you're Latin American. Latin Americans don't like snow. There's a lot of snow in Quebec. But aside of all those things, keep in mind that the best silver asset in the world that they are the majority owner of traded recently, and they didn't buy it, right? In Mag Silver. So that in and of itself, them, and maybe this is a reaction to them missing on that, or this is an intentional, and what it feels like is this an intentional strategic move to basically saying that they have significant concerns about developing assets in Mexico. Maybe, back to your point on silver versus gold and that premium multiple, they can get it, but it's not really a multiple. They paid cash, right? They paid $780 million in cash, Canadian. So I don't know if that works out to about $5 US. But the current exchange rate, at least that feels like what it feels like as a Canadian. But that to me is the surprising part, is that, this is a company that had an opportunity to buy something that they knew exceptionally well and didn't pay up for it, and then decided to go buy a gold asset in Canada. I don't think that bodes well for Mexico in any way, shape, or form, based on that vote. Because this is a group, Fresnillo is a group that has connections in the government. This isn't their first day there.
Yeah, I mean, when the Max Silver transaction occurred, we did talk about how it was trading at a premium even to the silver companies because of the unique nature of the structure. That more resembles a net profit interest, that's closer to a royalty structure than it is to an operating company, so it deserved a higher multiple. And maybe it was too hard for them to pay up that multiple. So we excused it from that perspective. I'm still shocked that the royalty companies didn't come in as a second bidder for that. But this is the second iteration, or the second line item of Fresnillo just kind of like skipping over Mexico, tacitly, obviously, this way by taking an asset in Canada. It's hard not to think that maybe they know something about Mexico that we don't. I don't know what it could be. It could be nothing, frankly. This is pure speculation on our part. But it's hard not to bring it up as a point of conversation when you've had, over the last 3 or 4 months, two different situations where the same company has effectively passed on an investment in Mexico. Could simply be an opportunity for them to use. Right now they have a market cap, and I know this was a cash transaction, but finally, they had a depressed share price for a long time. Now they're trading at a pretty reasonable multiple. Maybe this is a kind of like a preliminary step towards a much larger deal in the future. They're setting up to maybe a merger with another silver gold producer, Hecla, or this is pure speculation, but it could be just sort of like the opening of the floodgates for Fresnillo to stop being these kind of like uniquely Latin American entity.
There's lots of reasons for the transaction, but we know that Mexico has had its problems. We haven't seen a lot of companies get significant permits. We know there are assets for sale in Mexico, and assets that are Fresnillo size. I think that this is a really negative read through Mexico. We don't have a lot of exposure. I don't think, or any exposure to Mexico at the moment. You're looking to the sky as if our portfolio is up there, but I don't think, and part of that has been this, right? This isn't the first company that's come out of Mexico and said, we need to have something elsewhere. I think Minera Alamos is probably the most significant transaction there, but Fresnillo doing it is I think, in my view, a much bigger issue. And then maybe just before we jump into, that was $780 million in Canadian in cash. Maybe before we jump into sort of the deployment of cash by majors or large companies, let's talk about the other silver gold transaction, which is Coeur buying New Gold.
I think it's pretty simple. It's a multiple arbitrage. Coeur trades at 50% greater multiple than New Gold. It's a U.S. company. It qualifies for a bunch of the U.S. passive index flows. So you effectively double your operational size by paying 60% of your market cap. And obviously, I think the expectation would be that they get revalued to the prior multiple. So there's a 40% net accretion on the deal. And you're going to drive more passive flows to your stock because obviously your market cap doubles. So you demand twice as many dollars from the passive flows on the indices. I think this one has more financial engineering than real synergies on the operational front. If
And
you ask me.
yeah, that would be in line with Coors past practices. The and what they've done historically. But I think the other thing to keep in mind with Coor, with this transaction in particular, is that one thing that we haven't seen, and we've definitely seen silver companies go out and buy gold. Right, this isn't the first one that's done it. Hecla's done it in the past. Coors done it in the past. Pan American's done it in the past. But because they're considered silver companies, even though their mix starts to lean towards gold, they still have a higher percentage of silver torque. They haven't really lost their premium multiple. Now maybe this is the one transaction that does it. I can imagine being the investment banker pitching this deal and being like, look, it's because that's what it is, right? It's here's the multiple accretion, here's what's going to happen, your stock's going to go up. And look, you guys have bought silver gold before, and it hasn't dropped your silver multiple, so you can do it. And the board of directors goes, "Oh, that makes sense. Let's go." And that's it's sometimes it's that simple, unfortunately, or fortunately. I mean, New Gold's had a very recent troubled past. They had major challenges developing Rainy River, which now is probably making money. They had major challenges. The transition at New Afton was difficult. So it's a company that's sort of been on the rebound and transitioning, and so it's a perfect time for someone else to step in and come pick it up. And I mean, New Gold is a long way from its founders, right? That's the other thing, is that you don't have you have. I mean, for lack of better description, you have people that are employees, and so they get their change of control payments, and they're not going to fight to stay. And so I think that all makes sense.
It actually makes a lot of sense when you think about it as a management team comes in, cleans it up, fixes it. That is essentially fully repaid, and sell at obviously assisted with the gold price, but probably like five or eight times the share price when they picked it up for a turnaround. So, in my view, it's being taken out cheap. But when you think about the exercise from beginning to end of the turnaround, cleanup, re-engineering of the company, cleaning up the balance sheet, making 8 times, I can't remember what it was. It was probably around $1. It's going off for around 10. So maybe 8 to 10 times that price. That's a pretty good exercise. It looks cheap on today's profitability. This is a company that has reported Q3 numbers, and they made about $300 million not in free cash flow, in like mine cash flow, US. That's pretty good for a company that's being taken up for 6, right? So 5 times operating cash flow. But yeah, maybe the time was up, right? Like that was the price for the people who came in, cleaned it, fixed it, and now are going home with well-deserved, retribution. Right?
I don't know. We were, you have to be inside the boardroom to understand exactly what's going on, but I'm sure that at some point New Gold was probably getting to the point with their operations turned around that they either had to buy or they had to sell. Their balance sheet, if I remember correctly, I haven't looked at New Gold in a while, but the balance sheet wasn't in great shape because they were still paying off debt from the Rainy River build, and so they're not in a position to build something. They can't really outbid anybody on a producing asset, and so this is the natural progression for them. And I think it makes sense. Congratulations to the New Gold shareholders and getting on. If you suffered a long time, you made some money. If you got in early, you made some money there. I guess just going from that, the company spending money, and these a weaker balance sheet, not being in a position to do something, to we talked about Newmont and Agnico's ridiculous free cash flow numbers. They're not, we're highlighting them. They're the 2 biggest companies, but they're not alone. All of these companies are generating free cash flow, and I think the consequence of that, we start to see M&A, which is obviously in a cash deal, right? With Fresnillo taking out Probe for cash. but we're also seeing cash redeployed uh, into investments. Just before we go to that investment piece, though, I want to talk to. This is something you and I have talked about in the past, but how important is it that Fresnillo is paying cash for Probe? Because this is something that a share deal is, but cash is something that is different.
Well, yeah, it's cash flowing from a balance sheet to investors' hands that are more likely than anybody else to redeploy into the sector. So it counts as an injection of external capital of 780 million from an outside source that's not currently at the market in one shot. So it is pretty significant. Like, today some of the larger funds that we have in our space approximate a $1 billion number. So this is kind of like creating one of those funds overnight. Naturally, this deal doesn't close for a couple of weeks, a couple of months. But when it does happen, all that liquidity will be injected into the system, and barring the expectation that there could be a top-up bid from another party, what most long-only funds would do is actually sell before the deal closes, because then there's an arbitrage opportunity where people with bigger balance sheet hedge funds and other people come in and start playing around with small margins. You're better off selling and redeploying that capital early rather than waiting for the 2 or 3 months that it takes from the date of the offer to the actual closing of the transaction after the vote and all the legal process that has to occur. So we've always said that we need more deals like this, where some of this profitability that we're talking about on the producers' balance sheets migrates directly into the investment arena for specialists in this space. And the best way when that happens is when they take out smaller companies, because like Probe, the majority of that share registry would be specialists that participate in our industry directly, rather than, say, in the case of Newmont, that would be a company that's already in a number of multi-billion-dollar market cap. It'll be on a number of passive flow ETFs, etc., that are not guaranteed to redeploy into the mining industry. Whereas in the case of Probe, you can almost guarantee that the majority of people there would be actually looking to reinvest in the mining industry.
Right. Yeah, I think that's a valid point. Now, and I want to mention that because I think the investment of other mining companies into juniors or into larger mining companies into smaller mining companies kind of fits that as well, right? There's this cash that's being generated off the side. It's in the business, but it's not there, and then it gets redeployed into these juniors that all of a sudden have the ability to move up, and that haven't really to advance their projects. Generally get a re-rating off those investments. So a couple ones that were kind of top of mind and very interesting for us were that happened just recently was Goldfields put $50 million into Founders, and B2 put $10 million into Prospector Metals. I think both those investments are very, very interesting for us for different reasons. First, maybe we'll go to the obvious one. We're shareholders of Prospector, so and B2 was already actually a shareholder of Prospector. They had put money in when it was very small, but they backed, same thing that we do, right? We back good teams, right? And so Rob Carpenter and the Discovery Group are a good team. So B2 came in and backed that good team on a small case, and then they were able to, and now that there's a discovery and there's something a little more tangible, they're able to re-up. And it appears B2 has a significant interest in the Yukon now with or northern Canada or far north Canada with.
But you have B2, you have Agnico, you have Kinross. There's quite a few producers that have keen interest in that part of the world. So does the small little investment vehicle called Olive Resource Capital, by the way. But no, I think what's crucial here is one, serious company with lots of expertise building mines, validating the project. They did it with the Snowline. We know where that's gone. That was also in the Yukon. But number two, remember the seasonal drillers. These guys are going to go back drill next spring. But you need to start planning that yesterday. And this money at this point gives them the ability to plan a full program for 2026 today, put in the deposits, get good rates, get some of the good people. This is what good management teams do. Could they have dragged this on a little bit more and maybe tried to get a better price and do a market deal or a private placement? Probably. Strategically for the company, what makes the most sense right now is to lock in the capital in a good partner, paper that's not going to hit the market 4 months and a day later, or now with life the same day, and also get that validation and stamp from a pretty real producer that validates the quality of the project. So in my view, excellent placement, excellent investment by B2, and obviously congratulations to the team at Prospect. We're pretty happy shareholders here.
Absolutely. I think that's well said. Now, the other one that I think is the other big investment that occurred that I think is really interesting is Founders getting a $50 million investment from Goldfields. Just 50.
Just 50.
50, like, not 50, 50.
Like,
And that's back to your, again, I haven't looked at Goldfields numbers yet for Q3, but I'm going to take a stab in the dark and say that they have an excellent balance sheet and that they're generating a ton of cash flow.
Mind you, these people are actually building windfall in Quebec right now. Like, it's not like they're sitting on their hands. But even with that monster capex in front of them, they still have the profitability to go, think a little bit further ahead and see, okay, what's next after Quebec. And obviously, you know this very well, that there's a lot of appetite into Guyana and obviously into Suriname being next door, and obviously also a pretty well-known mining jurisdiction with Newmont already operating in the country. So what shocked me on this one is the absolute number. You know this part of the world very well. What can you do with 50 million in that part of the world?
You drill a lot of holes.
An absolute ton of
yeah. Well, I mean, I don't think that I get a couple things. But maybe just back up. There is a lot of companies that have a history in West Africa. Goldfields being one of them. Obviously the political situation in West Africa has deteriorated materially. And while there are still pockets that are okay, companies are really, really trying to take risk off the table in that area. And I think that this is the interesting part about, sort of the Guyana Shield is that it's really just an extension of the geology in West Africa. So they're very similar. So from that perspective, that's why you're getting these companies kind of migrating that way. So that's the logic. Like you said, Suriname is an established mining district. You have Newmont and I believe Zijin's in there as well, operating mines. And there's interest in the area. And yeah, $50 million. I mean, to be fair, $50 million could do a lot of work, but $50 million would do a lot of work anywhere in the world. I don't think it's as unique to the Guyana Shield. And frankly, I'm a little biased when I say this out loud, with the exception of maybe Omai, a lot of those operations are very, very remote, including Founders. And so it can drag up the overall, how those dollars stretch. But I know what we can do with $50 million at Omai. We have 60. And so, there's a long way to go. I think it's important that they stay below 10, the strategic stay below 10%. I think that's a key milestone. 10% leaves room for someone else to come in potentially in the future. I suspect, and I haven't looked at Founders that closely lately, but I would suspect that there might be a chance that this gets Founders to a maiden resource. That's probably important, and clearly Goldfields thinks there's one there. Otherwise, they wouldn't have put this money in. So, but I think that it just highlights, how much interest there is in the Guyana Shield, and that these companies are out looking for projects, and in places where you can. It's a little bit easier to get mines built.
100% agree. But I think just, by not nitpicking the specific stories, like This is just the validation that the money is starting to migrate down cap from the larger producers to the smaller producers to the developers, eventually to the exploration companies like Prospector. We've been expecting this to happen. That was our call for 2025. It's materializing, and frankly, in spite of the price of gold being like a rocket ship, it still feels like we're still reasonably early in the investment cycle of gold. The profitability, I don't think it's ever been this tremendous, like the numbers you were talking about at Agnico. But I think in terms of the money flowing down, it's only just now starting. There's a lot more to come, and that makes me comfortable in thinking that even though the price of gold has shot up so aggressively, we're still early. There's still a lot to do here and a lot to profit from as the money migrates down cap.
Yeah, I think that's a good point. And kind of to your point on, we're talking about, cash injection into kind of specialist funds, right? The founders again would be, I mean, there'd be probably some generalists in there, but generally it would be primarily specialist funds that own that stock. Well, instead of founders having to go to all its specialist fund shareholders and get that $50 million to get to the next stage of development, that money has come off Goldfield's balance sheet, an outside source. It allows founders to get to the next stage of development, but the investors, the current investors, haven't had to fund that, right? And I think that's a very valuable thing, right? That you're seeing a project advance without having you having to, and I say you in kind of a very general sense, about the market having to write a check into it. And so I think that's positive, and I think we're going to see more strategic investments. I think we're going to see more M&A. I think that I think the gold price taking a pause makes a lot of these transactions a lot more doable. I think when everything's up on a stick, it's very hard to do anything. And then now this stuff is everything's kind of settled a bit, and everything seems to have found a level around 4,000. We might see more M&A to come and more strategic investment. So, we're which is why, even though things look pretty bleak about a week and a half ago, with gold pulling back less than 10%, it was the right answer was to stay invested and to be buying, and we're gonna continue to be there. So with that, I think we'll wrap up this episode, and we'll talk to you about next week and see what else has transpired in this market. Thank you.